Hello everyone and welcome to our Q2 Construction Insurance Power Panel here at Insurance Business TV. Now in this edition we are going to delve into a variety of topics from the impact of inflation and interest rates to ESG standards and supply chain issues. To do that, we welcome our expert panel, Sam Hiller, partner in construction at Gallagher, and John Thacker, Chief Commercial Officer, Construction and Infrastructure at Aon. So welcome both, and to get us started, how are inflationary pressures and indeed rising interest rates affecting the cost of construction projects across the UK? And indeed, what implications does this have for setting accurate insured values? Sam, I'll start with you.
Thanks, Paul. So starting with construction cost inflation, that has dramatically increased from 2020, I suppose largely due to COVID and delays through the supply chain there. I'd say it peaked in 2022, but prices for materials do remain elevated. The Building Cost Information Service forecasts a 17% increase in building costs over the next 5 years, and labour shortages have driven up wages, and forecasts there indicate about an 18% rise in labour costs by 2030. Turning to rising interest rates, that has just increased the cost of borrowing for developers and clients, which does ultimately affect the viability of projects and has led to delays or cancellations, particularly in the residential sector. So the combination of high construction costs and increased financing expenses has made some projects unfeasible, unfortunately, which has led to a slowdown in new developments. And setting accurate sums insured, we've seen firsthand, sums insured increase throughout the construction period of a project, often exceeding the original contingency budgets and requiring the client to adjust the policy mid-term. So if insured values are not regularly updated to reflect the current costs, there's a heightened risk of underinsurance, and that can lead to inadequate coverage, which is obviously bad and exposing clients. So it's important for clients to complete regular rebuilding cost assessments through the life cycle of a project, and fortunately there are some safeguards out there. So we've got, it's pretty standard, but we've got an automatic clause in the policy, which we call the escalation clause. So that will automatically increase cover for clients who may not have notified us, but there is a threshold of generally around 15% on that. And lastly, we do feel that underwriters should perhaps factor this in to their rating models at quote stage, and it would certainly help them with any potential capacity restrictions.
Yeah, and just to go back to a point that Sam made earlier there, John, higher interest rates very much affecting the viability of projects, aren't they?
Absolutely. The higher interest rates will certainly result in borrowing becoming more expensive and the overall price of construction projects increasing. So certainly from the inflation perspective and the rising interest rates, this will have a knock-on effect with supply chain issues and also shortage of labour for building materials. We've previously seen this with the increase in the price of steel. And therefore, as we will talk through this podcast, there are other issues for contractors to consider when they're looking at the increased values. And so we'll look at the methods as we start to go through. The government are committed to more projects, but with that, the commitment looks at the demand for materials, pushing the prices up, and that will mean that contractors may need to consider looking at the suppliers and maybe overseas to bring those the actual materials in to try and keep the price and cost down as much as possible. Contractors' profit margins are always tied at the best of times, and the subcontractors, in a similar vein, they're always going to be vying to trying to keep the cost for each of the projects and the profit as high as possible. But this will have a knock-on effect with regard to developers as well, as they maybe see the profit eating away as the values and the interest rates actually increase. So yes, there's affordability issues and there's a viability issue with regard to the government as to whether they prioritise what particular projects they need to look at as we go forward in the construction sector. Yes, the accurate insured values that Sam's mentioned as well needs to be considered. And one thing as well is that insurers' capacity may well actually have an impact on that. They may not be able to write as much as the values go up. So their capacity and what they're able to write may take an actual overall effect and a knock on from there.
Interesting to hear you talk there, John, about rising costs of bringing materials in from overseas. It makes me think of Brexit, of course, and indeed, what impact are those ongoing post-Brexit supply chain disruptions having on construction timelines? And indeed, how are insurers responding in terms of coverage terms or exclusions?
Really good point. And obviously, it's not unusual for most, if not all, construction projects to be delayed. I mean, we don't see many projects, with the exception of a project that we placed recently. They actually completed on time by 1 day, but that's very much in a minority. Every single project's delayed for one reason or another, and sometimes and then the increases in the values, and there's also the variations that come into that as well. So firstly, you have that particular issue. You also have the issue of contractors who over the past 24 months have fallen into administration, which again has a bearing and a knock-on effect on the overall construction delays and projects. In those instances, the construction project may have to actually sit idle for a while until a new contractor is brought in and then can actually start to carry out the work again after that. So the post-Brexit supply chain disruptions are certainly causing significant delays, and that cost increases in the construction projects leads to project postponements and potential financial losses. I think from an insurer perspective, certainly one of their main concerns is delaying startup. So as and when there is a particular issue with regard to having delay in startup and a delay, that's where insurers become even more interested, because they're actually concerned with regard to not only the project itself, but if there is a significant delay, the loss of revenue that they may have to pay after that.
And what about you, Sam? Are you seeing any impact on construction timelines?
Yeah, thanks, Paul. Just to completely echo what John said there, the vast majority of construction projects, unfortunately, don't finish on time. So it's something that the market is well used to. But in terms of impact on construction timelines, yes, been a huge delays from customs. The trade and cooperation agreement introduced significant customs checks and paperwork and all these sort of regulatory formalities at the UK-EU border, which, just increased time and cost in importing materials and equipment. Those delays, were particularly problematic for projects with the just-in-time model. A big example of that is modular construction. With the result that deliveries are often slowed by weeks, which pushes out program schedules. This causes further problems in the event of a major loss, whereby the works need to be reinstated in good time, which could in turn drive up delay and startup claims. Freight costs have spiked due to fragmented shipping routes and increased transport costs, with port congestion and shortages of HGV drivers. Logistics reliability declined, so further disrupting the material delivery schedules. And Brexit has shrunk labour supply, especially from EU nationals in construction and haulage. So that lack of skilled labour compounds supply problems and causes further timeline slippage. In terms of insurer responses, we've seen sublimits under the constructional risk section for transit, rather than what you might know as full value cover. Insurers encourage stress testing of supply chains and logistics routes. They ask questions, of where's the suppliers and where's the materials going to be shipped from. And sometimes we've seen a loading to DSU premiums on projects where clients are heavily reliant on the just-in-time European supplies.
And are you noticing a shift as well, Sam, in insurer appetite for high-rise residential, indeed mixed-use developments, especially in light, of course, of the evolving fire safety regulations that we're seeing, such as the Building Safety Act?
Yeah, I mean, firstly, for clients, it's caused huge delays to schemes getting off the ground. We know it's been very hard for developers to navigate the Building Safety Act due to the perceived confused and lengthy submission processes. So a lot of residential, including build to rent and student accommodation schemes, are delayed or even on hold. But turning to the insurance market, we've seen sharper underwriting scrutiny since Grenfell. Insurers now scrutinise underwriting information on mid and certainly high-rise residential buildings. The main information they're consistently looking for is confirmation that building facades and insulation materials have been classified as non-combustible. And there have also been insurers which have pulled out of writing high-rise residential buildings completely. However, that is also largely linked to significant escape of water claims. But we are seeing now in 2025, a softer market than recent years. So some of those insurers are coming back, which is positive. There's increased regulatory compliance requirements, which has led to improved risk information, which is great. So the Building Safety Act, alongside construction-specific codes of compliance, such as the Joint Code of Practice, has made it a requirement to comply with stricter guidelines around fire safety and preservation of life. So, in turn, more risks have been considered within the design phase and during construction, which improves the risk profile of high-rise projects, we think that's great, and we're trying to kind of highlight and advocate that.
It's a good point there, John, from Sam, in terms of entering a soft market, because that does indeed have an influence as well, doesn't it?
Absolutely. Just back to exactly as Sam was saying, look, the insurers had become cautious and selective in their underwriting, with more increased scrutiny around higher premiums for buildings, especially with those ones that did not meet the building standards. So with a shift now with regard to the Building Safety Act, there is a lot more interest, and insurers are certainly very much required a lot more information. So the softening of the market will make an impact. To what extent, we don't know. Insurers will still expect risk management to be considered and implemented, along with the consultation with the fire brigade, to make sure that all fire safety regulations are complied with and included within the design, and therefore undertaken and complied with during the works themselves. So there is a growing need for collaboration between insurers, between building owners and safety experts, to find innovative solutions to address the challenges of fire safety in high-rise buildings, which will still be a concern to insurers. But as we, Paul, as you mentioned, move into the softening market, this may become maybe less of a challenge, as we've seen during the hardening market.
And I feel as though no conversation about construction insurance is complete right now without talking a little bit about sustainability and ESG standards and how they are influencing the types of construction insurance products that clients are seeking in the UK. So, John, are you seeing an impact there?
Absolutely. I think certainly from our perspective, as you say, the government, the regulatory bodies have definitely implemented stricter environmental and social standards. We've certainly seen a lot of requirements more to actually take away from the standard construction methods and bring more into the low carbon concrete in relation to the mass timber, the CLT, to actually make this, to take away the projects as they were into a more social and environmentally friendly prospect. The considerations we have from an insurer's perspective is twofold. One, the construction industry is still looking at these particular projects, and there aren't that many projects that we've actually seen so far in the UK. Overseas, in Canada and in Scandinavia, a lot more in relation to CLT projects have actually been constructed, but it's actually trying to bring it into the UK and how we can ensure that, because insurers will always look at data and claim statistics that they can actually look at. And I think from a construction perspective in the UK, insurers are still treading carefully with regard to that. We're making progress, but where insurers would normally write bigger lines for a 100 million, 200 million pound project, Once it actually involves timber, then they start to become a little bit more selective. And where you may have had 3 or 4 insurers writing, the capacity will probably be 10, maybe more, to actually write that particular risk. So we are seeing people treading carefully as they start to look forward in relation to that.
Okay, so the industry perhaps treading carefully a little bit. And what are the solutions in general here, Sam?
Yeah, I mean, a particular area of focus for insurers is developments that include structural timber, like John said, but also refurbishments, modular, and there's even talk of prototypical materials like low carbon concrete. And all of those come with, much more challenges from a risk and insurance perspective. So focusing on timber to start with, the reason why it's challenging is insurers have centuries of data on traditional frame buildings and how they perform over time and under different loss scenarios. Unfortunately, to John's point, insurers just don't have the loss history yet for engineered timber on certainly tall buildings in the UK. And yeah, insurers' view is that it's more susceptible to fire and especially water damage than concrete or steel. So there's nervousness, limited capacity, and that results in higher rates and etc. Insurers, whilst sustainability and ESG is increasingly part of the conversation, ultimately they are still led by profitability and delivering to shareholders. So unfortunately, there's always going to be nervousness until more and more of these sort of pioneering projects are built. But the good news is, slowly but surely, they are coming through, especially in London. So to answer your question, Paul, specifically, practical top tips, I would just say, it's a bit of a cliche, but engage your broker early. You can't do it early enough during the design. Appoint a specialist timber subcontractor early in the process with a view to novating that to the main contractor. A really important one is you've got to do a bit of a sales pitch to the insurance market, not just construction underwriters, but their risk engineers. And if you can, try and include the post-completion property insurers in those sort of sales pitch type meetings and present a really clear and considered risk management strategy. Touching on existing structures, major planning authorities, especially in London and other councils, have made it more and more difficult for developers to demolish buildings, with a strong preference for them retaining them where they can, for carbon reasons. The challenge is, unfortunately, clients don't always appreciate that the insurance market is made up of many, many different specialist areas. The big obvious two here are construction and property, construction phase and post-completion operational risk. So, a construction insurer, their kind of core appetite, as they would call it, is new builds of traditional frame. And equally, a property insurer, their sort of core appetite is existing operational buildings that aren't being worked upon. So, there's nervousness there. But what we tend to see, it helps if the retained structure is being redeveloped. The reinstatement value of that is similar to or less than the new works value. It helps if the building is not that old, sort of less than 30 or 40 years old. Ideally not listed and also unoccupied during the works. We have more success with those kind of projects. And then how clients put their best foot forward. Carry out extensive investigations of the structure before starting the refurb. So any undiscovered damage can be factored in during design and sort of minimize that delay risk. Provide a recent condition survey of the building alongside a clear plan of what will be done to fix. And if you can put that in front of underwriters, early on at quote stage, it helps them tick that box. Then there's other subjects, low carbon concrete or green concrete. There's certain types out there that have been around for years and adopted on many projects and tried and tested. So that is generally acceptable to insurers. Unfortunately, at the moment, most insurers deem the kind of zero carbon or chem-free concrete as highly prototypical and unproven. But there are conversations happening in 2025. So watch this space. And then modular, there's concerns around water ingress due to connections between units not being watertight. So there's an increased premium. It's not as significant as timber, but still insurers haven't got masses of data as to how those buildings perform over time, so there is nervousness. Also, the manufacturer's technology does vary, so long-term relationships between the contractor and the manufacturer and the supplier is key. And then just practical things like, providing details of the module production facility. Where is it? What's the security? And just, communicating to insurers, details on storage prior to use and installation. And ideally, if there's a kind of alternative site for module production, if the original main facility is unable to function.
Awesome. Excellent tips and a great breakdown there from Sam. John, anything that you would add on this?
Yeah, absolutely. So I think obviously Sam's picked up on a lot of things there. That's certainly, and the key is absolutely bring the broker in as early as possible as well. But during particular projects as well, the fire safety, the water management plans. When it comes to timber, for instance, we still have insurers asking the question: what happens in the event of a major fire at a building that is made up, significantly not so much of concrete, but it is actually of a timber frame. What happens there? And it brings me back to thinking about composite panels where fire brigades would turn up and actually just stand back and let the whole building just burn down. And I think there are the suggestions from insurers, maybe rightly or wrongly, that may well be the case if a fire takes really takes root in relation to particular projects. What happens there? Because a lot of our clients will say, well, particular floors can just actually be repaired in relation to wooden structures. But I'm not sure insurers are seeing it quite that way at the moment. And not only is it fire, if you do have the escape of water with an existing building, it's almost similar because you then have a very wet building and it's trying to dry out the whole of the building as well. So there are still issues. I'm not trying to put a damper on it, but there are still. I think there's a way to go. We are educating insurers, and by bringing the clients in front of the insurers to educate them, it's only going to work well to actually move that forward and give the clients the products that they're going to start to strive to require as they get more and more involved with these projects.
You agree with that, Sam? Still a way to go?
Yeah. And pardon the pun there from John, doesn't want to put a dampener on it. But yeah.
Yes.
So there are some solutions. So moisture and water is a huge problem, to John's point. So there's technology out there that clients can put, not just escape of water and the kind of well-known, automatic leak detection, shut-off valves type risk management, which is fundamental, but also the moisture monitoring. So there's technology now that you can put on a timber scheme that monitors the moisture of the timber on a regular basis and provides immediate information to the site, which reassures insurers. So I think there's progress being made. It is still challenging, but I think the key point I would just like to get across is progressive developers trying to push sustainable buildings need to see their insurance broker as almost part of the design team. Engage us early. They've got a structural engineer, lawyers, cost consultants. The list goes on of the professional team. So we don't need to be spoken with as much as that, but once a quarter at REBA stage 1 in the design, have a meeting with the broker, and big benefits can be had from that.
Some great tips from you both so far. Just one final question to throw at each of you. This is, of course, a volatile construction environment. So what challenges are you encountering in terms of accurately assessing reinstatement costs? And indeed, how are you advising clients on avoiding underinsurance? John, any thoughts?
Yeah, quite a few, Paul. Just in relation to the whole, actually, as the assessment of the values themselves and how the client gets to the reinstatement values is very much, it's not so much out of our control, but we as insurance brokers will always challenge values that have been provided by qualified professionals. But in fact, in relation to that, our clients will rely very much on the assessments and the values that they are provided from the outset. So from a construction perspective, it's very much reliant on first the estimated contract value before you then get to the reinstatement of that particular project. Once you move into the operation, that is certainly key when you're looking at the reinstatement and the value of the property itself. But it's not just the actual the property once it becomes operational and therefore potential underinsurance. It's even during the construction phase. Sam's mentioned existing structures, and certainly if there's existing structures that are incorporated within the project, the construction project, whether it be refurbishment, or actually incorporation of any sorts, then it's key that existing structure or the building is valued correctly, and we need to make sure that is not underinsured, because in the event of a claim and the building is significantly damaged or completely demolished, then it's the insurance for that existing structures will be the value of what we're insuring for. So if we are then looking at that particular value and it's underinsured, that is potentially a big concern. We don't have average within construction, so there isn't normally that particular consideration that you may have when you get into operation. But it's not just existing structures as well. I know Sam is going to touch on delay in startup, but there's also third-party liability. And when we're looking at surrounding property, if it's in central London, clients need to consider exactly what limit of indemnity they need to be insuring for, because again, if there's a fire, a tower crane topples over, or other significant issues, called from a 651, a non-neg cover, then there may be the fact that they've actually caused significant damage and injury to third parties that their limit of indemnity does not actually cover. So there are different areas from an underinsurance we need to consider, away from just the main, maybe the contractors or risks and existing structures, the values that we look at.
Yeah, client considerations are key here, aren't they, Sam? It's difficult for them at the moment.
Yeah, and thanks, Paul. Just to John's point, it's a point well made that construction risk, there's not just one insurance policy. There's up to about 8 or 10 that are relevant, different subsectors of the construction market, all with different, complications and considerations. But yeah, really challenging for clients. We've seen a huge amount of midterm adjustments to policies to increase the sum insured, which obviously tends to result in an additional premium. So it's challenging out there. As we've talked about, materials and labour costs increased, compared to that agreed or estimated at the start of the project. So especially for projects that are longer than say 2 or 3 years in construction period, it's really challenging. Some big uplifts out there. So to avoid underinsurance, we tend to advise clients to include the following within their sum insured. So all contract variations, that's important. Cost inflation forecasts, and then professional fees and preliminaries as well, like site setup costs. We think clients should include an allowance for escalation or have adequate contingency, and have regular, mid-project reviews of your sum insured. Another one is align the delay in startup indemnity period to be the worst case rebuild time post a loss. That's a crucial one, especially if you've got a huge, anticipated rental income, or perhaps you've got lenders or investors on a project that have lent money. They're always keen to focus on the delay in startup risk. And then, finally, last but not least, just communicate. Have regular catch-up meetings with your broker, and through those conversations, people like John and myself can ask questions and give support to clients out there, to help them, focus on it and make sure their policy responds in the correct way.
Well, excellent tips from you both, and indeed a highly informative panel. Huge thanks to Sam and John for their time today. And remember, this band will be back together in Q3. But until then, keep it right here at Insurance Business TV.